Now, this is reread, and this is saying so far there is no sign yet of a major turn in silver, but the monthly chart is improving tremendously, and you've got the weekly chart. Now we go to the weekly chart right here, and the weekly chart with this particular candle says it's real easy, because if you remember what I had said, let me just show you something. What I had said is the Chapman wave Roman candle. This has all the characteristics of a Roman candle. In this case, it's a green one rather than a red one. But look what happened to the general market INDU right here, October the 15th. You see that candle right there, that big candle? So here's my rule of thumb. It's just a real easy thing to do. When you get a candle, let me go back to silver. When you get a candle like this, like that, it says that I have to call this a leg F, and it'll be a trough F if next week there is no new low bar, and I see no reason why there should be next week. A low into the 14.155 level? I doubt it. Now, I just gave an update to my subscribers. I said I never give intraday updates, because I found over the years just once or twice it's been perfect to get off a short position in the indexes. Most of the time I could have got a better price the next day without any fuss, but because I felt that there were things going on and I felt a little hurried this morning, I said, you know what, I'm going to give an intraday update. I'm not sure if I'm going to do anything, and all I did is to say our positions are such, and I'm giving you no extra advice at all. We'll have plenty of time tomorrow to do anything we want, even if we don't get the best price. I'd rather see the day close. That's number one. Number two is I'm going back to the candle. And the reason why I'm going back to the candle, it says that this particular candle is really actually, the wick at the top is too much for a Roman candle. The daily is much better, but not the weekly. So that says it's still the same principle, that if there is a close underneath the low of the week of 7th of November, under 15.095, it's not a price move, it's a close on a weekly basis. Then it says, watch out, we will be testing close to or right at 14.155, the low of Monday. Okay, but here's the other side of the coin. If we close above for 2 out of 3 sessions, above December the 1st high of 16.810, that would suggest that this is a low of consequence. It is a Chapman wave volume spike, price low, reversal pattern, and it says that you should have at least 28 sessions. In this case, it's a daily chart, 28 sessions before you even come back close into the lows of the 14 area. So it says upside action, then you might arch over and you might be coming back, but you should not break the low before 28 days, and that'll take you into about the 2nd or 3rd week of January, trading days, that is. So we'll be following that. That is, if there is a close for 2 days out of 3 above 16.810 in the continuous contract of silver. So that's what I wanted to get out there. And the other thing is in gold, and one of the reasons I mentioned my update is that I really thought about gold. I thought, is this the time that I want to add back into the gold? We only have done that periodically and months and months because I've been so negative on gold. I still think gold is going to go lower, especially with the patterns that we're looking at. But I had said that November, December is a period that I'd be looking to see a chance of at least a really good tradable rally in gold. But you know what? Yeah, it's possible, and I'll have to reassess tonight. Maybe I've missed a great opportunity. Look at the dollar. Look at the dollar's action. This is very strong. It's restarted. In fact, it isn't at 80% yet in the daily chart, gone back to 80%. It's at 79.89. The MACD hasn't crossed over, but it is just about to cross over, but the day's young. Let's see what happens. But this particular pattern says there's more likely legs seen that there should still be a D to come, and that the USD JPY, which has gone in lockstep with the dollar, is acting very well as we speak. So I don't want to change. You know, currencies do not change on a dime. I love saying that. Currencies do not change on a dime. There, I said it again. Why? Because invariably they don't just have you and me trying to trade, little kind of thing. And it isn't funds trying to trade. It is countries. Huge mega bucks are going to these particular instruments, especially like the EUR, USD, the volume in bonds as well. But look at the EUR, the EUR, USD, the euro dollar currency pair. It is about to test. This is leg E in the weekly chart. I've been terribly negative on this as well. And look what happened. It failed to break and hold. It went to a peak F in the Chapman wave in the monthly chart. And lo and behold, it broke under the 200 period moving average again. And this is exactly within 20 to 30 cents. It's got to hold 1.224. It's at 1.2310. Wow, it is really close. That major trendline support, it's got to hold that. I will be back straight after this break. Basil, Chapman, 2006, S&P's up 3, and I'm sitting for Larry Pesavento.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Check out the new look of Tiger TV. Now you can see a host, charts, and computer screens crystal clear in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Thinkorswim, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back. So what I'm showing you is we're going to go right back to chart patterns in a second. Construction set for new East Boston apartment complex. I've been showing this almost every week now. Actually, this time it's been almost every other day. I've been showing construction in the Boston area, which historically, as long as I've been here for a very long time, invariably, whenever I see this, it says you are close to recession. And construction set for new East Boston apartment complex. What is it? 7 floors will be added to a one-time confectionery plant, a 9-story building that has been unused for decades. Now, I'm not grumbling about all these developments. I happen to love architecture. I love good architecture. I love great city planning. I mentioned in the Den, Chicago-based hedge fund. Hey, I think when you go along the river in Chicago, that is just a beautiful sight. It's just so nicely done. I love cities. So that's not the issue. The issue is the plethora of developments. And invariably is setting the stage for overbuilding. I mean, we're going to have a glut. Brooklyn is going to have a glut. We're going to all have a glut of apartments, etc. You talk about the rentals. You watch rentals come down in the next 3 to 5 years. You watch them not only come down, you watch them go down and down and down. Anyway, until then, we'll be watching this closely. So here's the pattern that we're looking at. Look, the H pattern. And the H pattern says you can keep making these little scallops, these little arch formations, and breaking the left side low for a long time until eventually you might find one where you may either make the V-shaped pattern bottom, or it looks like a V and then it fails and it does what's called in the Chapman wave, the lowercase M pattern. And that's there. Well, look at that. We've done that. Look at the weekly chart. Look at this. Look how many scallops there were to the downside. Look, all the way down, all the way down. Well, we're getting close to the point where the Euro USD has to find some kind of a base. But the best that you can expect in a move like this is that it'll make an arch formation that'll fail and retest, and then it'll make another one, and it'll take weeks, and then it'll take months, and you turn around and you say to yourself, oh my goodness, is this thing never going to go up? And look what happened with the gold. See, now what happened is in the gold pattern, I drew this ages ago. Let me just show you something right here. I drew this a long time ago, over a year ago, right there. I drew the H and then I put in the M pattern. Recently, I put in another one because here's the third one. Well, this is the third one that says from the low that was made, there has to be an immediate bounce back. When you take out the 114.40s support that it held for so long, the very next bar or one later maximum has to get back into the body. In this case, it has to get back over 114.50 and hold there. We're at 116.26. But the pattern itself so far is just one of kind of a slow move to the upside. There isn't any real force. What would have been spectacular is if the GLD on Monday reversed. Tuesday was maybe a doji candle at the high, not at the middle, but at the high, and today was already at 117.80 to 118.30. I'd be jumping on this thing. I'd be saying, that's it. Now we can get that larger move that looks like the M, which should be a much greater arch formation, or you could even start a rally that takes you for 6 months or more. At this point, I just have to say that yeah, it's wonderful that you're moving higher, $1.10 up in the GLD when the dollar is at recovery highs. But I'm treating them separately now, at least for now. So, okay, that's that. Now, what I want you to do is to show you. So the EUR USD we just did that, and then I had a question the next question, let's just look at a stock. EOG was the question. EOG is EGO Resources, product and marketing of crude natural gas. That's what I've got written here. And there's that H pattern that's trying to work here in the weekly chart. Here is the monthly, which had a very quick A, which will become an A minus if it fails. Now, the big question is, is this a move? Look, this is peak A. Let me just do this for you. Look, there's the low bar. There's a peak A. And in the Chapman wave methodology, you identify the lowest low bar. And if the technicals are confirming with the price movement, what you want to do is to notate alphabetically in sequential order, peak A, then peak B. Remember, this has got nothing to do with A to B equals C to D, absolutely nothing to do with it. This is identifying and labeling each higher peak. That's all it is. And your objective is to get you to D, and is D where you can have the sharpest and longest decline. Lo and behold, that was the sharpest. It isn't the longest yet decline. It is the longest decline so far since the low bar that was made in EOG at 8107. So I'll finish this up because I'll tell you that if it goes to 95s, then the 200-period moving average becomes a magnet. I'll be right back. Dow's up 1, S&P's up 3.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. Basil Chapman sitting in for Larry Pesavento. I'm hoping Larry will be back tomorrow. So it sounded a little bit, not a little bit, quite a bit awful, actually. So I hope he's going to do well. So here we are. This is the triple yield chart. This is the 30-year triple yield chart that I wanted to look at. Did I finish what I was doing before? Oh, no. EOG. Sorry. Let's go back. I'll come back to the triple yield chart. So here's the story. If you are long, if you aren't long, now you've missed the best opportunity to get in, although it's in leg B, in the 120-minute chart. EOG, this is EOG Resources at 92.53 up 2.21. It looks like it wants to test 94.43, the 200-period exponential moving average in the 120-minute chart. It needs to close, though, above the 9-period moving average in the daily, which is at right there at about 92.93. So it needs another 50 cents to be able to do that. Most importantly, what I'd be doing is I'd start a small position if you were interested in EOG, but I'd have a really tight stop because I can tell you if this thing closes underneath 80, 89, that 89, 88 area, it's just done. It's not going anywhere. And as it is, I would only treat this as a counter trend bounce. And as a counter trend bounce, I'm drawing in the H pattern that goes to an M pattern. Now I can show you the chart. Look, there's the H right there that goes to the M pattern. And that's the best that I can see for now. And in the meantime, back at the ranch, if it does succeed in closing into the 93.88 or higher level in the next 2 days, then all of a sudden that 200-period moving average in the daily chart becomes a magnet. It's been a repellent zone. It's been a propellant zone. Mostly it's been a repellent for the past month and a half, 2 months. So now you want to see it hopefully become an attractor, a magnet, so that it takes it from 92 to 98. And then you're going to have to deal with it, and let's see what happens there. So that's what I'm looking at. So what you've got? You've got a risk of, I would give it a risk of 1 point with a gain, potential gain of between 2.5 to 4.5 points if everything works out. So, the question, statement was that so many of the commodities have this dreaded H pattern, this lowercase h pattern that I showed you in this particular example right here on slide 335 of my CD introducing the Chapman Wave methodology. They don't usually come off bottoms very easy. Not when monthly and weekly charts are doing that. So you got to be a little bit careful. Now, I'd also said that I would look at bonds. So here we go, bonds right here. So the bonds is the triple yield chart. The white is the 30-year, the goldy brown is the 10-year note, and the cyan is the 5-year note. And you can see nothing's happening. It's stuck. I told you it's going to be in a trading. I even put the rectangle there. It's within this rectangle. Let's see how it performs. I'll come back to it again either tomorrow or Friday, and we'll see what's happening. But I think bonds are just stuck in a range. Let's go to William in Singapore. William, how are you?
Great, thank you. Thank you for picking up my call, Mr. Chapman. I would like to ask you the question regarding Tesla. What is your view on Tesla based on your Chapman theory?
Okay, so this is a very good question. I've been talking about Tesla for some time as probably going to have these periods where when it's out of favor, it's looked at either as a battery company or not any good anymore because gas prices are coming down. It's looked at completely differently to when it's going up. And right now, the pattern that I just spoke about, this H pattern, which also is a chapter in my CD introducing the Chapman wave methodology of, it's also called a right shoulder failure pattern. I'm just going to show it to you right now so you can see that patterns repeat over and over, and if you identify them, if in your mind you have a template, a picture of them, you'll be able to identify patterns. There's one right there, slide 363, right shoulder failure pattern. There's a perfect one. This is exactly the pattern in 1987 that the Dow made when it had the sharp pullback from the high of 2237, I don't remember what it was, mid-August, and then it pulled back and rallied and stopped dead and with a 0%, an exact unchanged level at a peak A or B in the closing price chart, and then plunged. And this is right there. So now what I'm looking at, there's the same pattern. It's done it actually twice. This is the second time for Tesla. Tesla's trading at 228.53, down 290. Now, I know that you've liked also to be long Tesla. Are you long at this point, or what is your position? You have no position, or what?
At this point, I have no position. I'm thinking whether I should have gone on short position on Tesla.
Okay, so the best opportunity would have been right where it made that first pattern, the daily, where it had a doji open and close on the 26th, and then went under the 9-period moving average and treated that as resistance. Now what's happened is it's very close to the 200-period moving average. Folks, we're looking at TSLA, Tesla Motors, fabulous car. I mean, I've not heard of anybody being very disappointed. Well, I can't say that I know more than a handful of people that even know anyone with one of them. But one particular person, no, two particular people, have just loved every minute of the car. They're really enjoying it. So what I'm looking at here is it's a product that is being bought by people who are not really trying to save money on gas. I could not believe that, not when you're overpaying at that kind of price. So they're buying something that's very desirable. It's a luxury. It is a treat. It is discretionary income. So what I'm going to say to you, William, are two things. It's sitting right on the 200-period moving average right now. If ever there was a chance for it to bounce, today is the day that it has to start the turnaround, and the 120-minute chart is just not looking very strong. But your best opportunity, you've lost your best opportunity, and that's a pity. I mean, risk reward. In other words, when it was a little bit higher, it gave you room. At this particular point, if it does go down, then 220.31 would be the next level of support. That's the low of the 27th of October. But the major support is going to be 217.32, October the 15th low. And it's gone up to a peak F, and it's pulled back, and it's making the arch formation. Now, William, are you going to short, or are you going to use an option? Because there's a big difference now.
Okay, actually I'm thinking of doing options, and I usually do a weekly option, so it's going to be very, very short term. That's why I'm thinking of taking advantage of the very short term drops, and then look for whether there is a likelihood that it may reach a bottom for a rebound.
Okay, so I'm going to suggest, if you're looking at the options, that you don't look at if you're looking at the near-term options, I would not do them right now. You'll be looking at December?
Yes.
Okay, I'm going to make two suggestions to you. Think about it, but this is what I'm going to discuss with you. If you were going to go short the stock, I would say short the stock right here, even though there's going to be a bounce at 228, and I would add to it at 235 to 236, and 241 would be my stop. That's the way I would deal with it. Why? Okay. Because if it went down tomorrow, that would be very negative, because that would definitely say that it wants to test the 220 level of the 27th of October. And if it tests that and it's below the 200 period moving average, there's just a really good chance it's going to go to 217. But if you're using options, you've got to be way more, your timing has to be way better. So this is what I'm going to suggest, because I'm not going to suggest a call, even though this is the period it should bounce. I don't know, do you use the MACD and the stochastic at all in your analysis?
Yes.
So if you,
yes,
do you use the 60-minute or the 120-minute chart?
Usually, I use a 5-minute chart for the entries signal.
Okay. So what's the longest time period you look at with the MACD and stochastic? Do you use the
daily
60
chart.
at all?
I use a daily chart.
So you go 5 minutes and daily. 5 minutes for the entry. I'm going to make the suggestion that you start including 30 minutes or 60 minutes, and I'll explain why. The 5-minute chart can give you fantastic signals, but it's only going to be for like an hour, maybe 35 minutes to an hour, because then it could change dramatically. Whereas a 120-minute chart, that's the closest you're going to get to the daily chart itself. So here's my suggestion. If you're looking for a put position, I would, even though you might miss it here, well, first of all, how many puts would you be putting on? Just 2 or 3, or a bunch, or what?
Probably about 5 to 10 contracts.
Ah, okay. As long as I know that. See, here's my suggestion. You could start one right now as a put, and and do you go near money? What do you do? Would you go for the 225s? Would you go for the 230s? What would you do?
Usually, I go for out of money put, between 220 to 225.
Okay. All right. Now that I've got a feeling for what you're doing, I've got a completely different strategy. So this is what I'm going to suggest.
Sure.
If you're going for December, where's my calendar? Just real quickly, let me look at my calendar. That Friday. So the 19th. So today is going to be the week of the 5th.
Yes.
Wait, today is...
We have about 2 more weeks.
So you have 2 more weeks.
10 days.
2 more weeks. And you don't want to give up. If it pops up 5 points, that hurts. That's going to be like, you're going to lose 35, maybe even 40% of your position. Okay. I need to do this very carefully. Now, between you, me, and Tesla, I'm suspecting that by Friday, 2 weeks, Tesla will be testing the 220 level. So that's 8 points away. Now, how would you play it? Because you want to get the best result. Okay, I know what I would do. Just so that you're in the position and you're prepared to accept that one position is the sacrificial lamb. You're going to have to take a chance, because if it drops from here and you have no position, it's better to have one position than no position. If it rallies from here, it's better to have only one position than more than one position, but at least you're in the position. So at 228.35, if you want to start one position here, fine. I don't have any problem with that, because you're going to be adding to it. But I would prefer to see you adding between 232 to 234. That would be ideal, because then I think your risk is maybe you're a few days early, because I don't see too many people buying Teslas as Christmas presents or Hanukkah presents or any presents at all. Or maybe they will, but not many people. I don't think it's going to make a difference to the Tesla stable. So I think that you are correct. And then comes January. It should be a very quiet period for Tesla. So the anticipation might be December. But if you actually ask me which put position would I prefer, I'd prefer January.
Oh, okay.
I'd rather have the time, because the premium will be, you won't make as much until the part of January where it's already kicking in, if it kicks in. But based on my weekly and monthly chart reading of Tesla, all it needs to do is close under 220, 2 out of 3 sessions, daily sessions, and that weekly will get so weak that it's bound to go even lower. So I don't want you to miss out on not being in the position. I just don't want you to overpay for it. So I'm suggesting you could get maybe one position here, but preferably you want more positions 3 to 4 points higher.
Okay.
And if I'm wrong and it starts to go down, I would add to my position if Tesla goes to it's a 228.43. If Tesla goes to 226.80, I would add another 1 or 2 positions. In other words, if I'm wrong and it actually does go down straight away without bouncing, that'll be very negative action for Tesla, and that's where you want to go into those positions. So you won't be getting the best price, but I think you'll be getting the right trend.
Okay, understand.
Am I clear? You start at position 1 now. Preferably you wait for a bounce to add to it. But if it starts to break down in the next day or so, then you want to get into those positions 2 or 3. And I would have a little bit of a stop on at least half your positions. I know that sometimes you hold on because you think you're going to go right through until the end, until the expiration day. I would still have a little bit of a stop on some of those positions. You can always add them back later. In other words, keep your capital, don't overspend, because Tesla's right on the 200-period moving average on the daily chart. How it handles is going to be very important. So I hope that the charts, if you can see them on Tiger TV, I hope it helps you. Now, the reason why I want you to look at the 60 or the 120-minute chart, the stochastic is flat. There's no strength whatsoever. Right. That's the reason why I said you could start one right now. So it looks like there's no strength at this point. Hey, good luck with the trade. Let me know how it went.
Yeah. Okay. Thank you.
Thank you very much. It's William in Singapore, and we'll be back straight after this.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days, unconditionally, so there's no risk to you, other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN.
Folks, stay tuned for Daryl Martin. He's back. Should be a great show as always. And the Dow's up 12, S&P's up 4. I thought just a narrow trading range. We'll see what's going to happen here today. It's really tomorrow and Friday that are so important, especially for the weekly chart on Friday at 4. Hey, look at this crude oil chart, the continuous crude oil chart. Made a peak D, if I use a phantom peak. It made a peak D back in July of 2008. Plummets from the 190 area. This is the continuous contract, so that's the price there. And it goes all the way down to the February 2009 low at about 63. I would say that that's a plummet. Now it's formed the H pattern that goes to the lowercase m pattern, goes on and on and on and on. And I remember I always talk about rectangle formations lasting a lot longer than your patience. Well, how about this? The patience is from 2009, 6 years. And finally it comes back. And what does it do? Last month it tests the low and it goes to 65.69. This month the low is 63.72. And it's getting ready. Look at the slow stochastic way down there. The MACD hasn't even really expanded yet. So it's just saying this could continue for a while, even if there's a bounce. And it's saying that we are real close to at least a bounce that in the daily chart. Let me just grab this chart, move it away. First, let me go to the weekly chart. Remember, we look at all 3 time frames, really actually 4 time frames, because I always include the 120-minute chart. But look at this. There was a beautiful left side, right side price time match, which took you right to that candle right there in November of 2014. This goes all the way back to not that low. It goes back to the low of October of 2011 at 74.32. And then what happens? So it's an exact price time match. Isn't that amazing? That you can wait a minute, whoa. Move that there. I think it missed it by 2 months. Yeah, it missed it by maybe 1 month, maybe 2 months. In this one, there's another one that was exact. And what we're looking at is that it then broke down, and you can see that the on-balance volume is making a W formation, and it looks like it's getting ready to turn. Let's go. We've got a few moments left. We've got Jim in Denver. Jim, how are you?
I'm fine, Basil. Thanks. How are you?
I'm well. We've got a minute or so to go. What would you like to look at?
TNA.
TNA. That's the IWM long side?
Correct, yes.
Okay. IWM right now is acting quite well. It's up 117.11, up 86. I personally would not at this particular point, play the long side of the IWM, even though it's acting reasonably well, because I think it's only got about a point or a point and a half. Then it's going to bump into a lot of resistance in the 118s if it's able to get there, and it'll only get there if this market continues rallying, or at least moving higher with limited downside into the last day of December. So I'm going to make the recommendation. You know what? We're going to run out of time now. I don't want to just jump in and say to you, buy it right here, because in any case, I would want you to see how the next pullback occurs, although the 120-minute chart says it should go. Are you prepared to pay it for just on the IWM for 1.5 points up, or are you looking for a position play?
No position.
Okay, so let me say to you, I'm going to ask you to hold off. I will talk about it tomorrow on my show. But in the meantime, the only thing I would say to you is if you want to nibble on it, you could just start a tiny position just to have your foot in the door. I personally would say, hey, wait a minute, let's look at it together tomorrow to see if it's going to pull back and break 115 support, or really take out the 118s to go into the 119s. Right now, I would not be fair to you if I just jumped in and gave you an answer. I'll give you the answer tomorrow during my show. Is that okay?
Very good, Basil. Thank you.
Thank you so much for calling, and that's Jim in Denver. Folks, stay tuned. You've got Daryl Martin, got programming right through the day. I'll be back tomorrow. Have a wonderful, wonderful day.